odd, but the way the venture industry works is the venture capitalists all, of course, have to co-invest with each other's deals. In order to co-invest, you need to convince all the VCs that it's a legitimate sector. And therefore, someone important has to say, this is an interesting industry, you guys should put money in it. If you don't convince everybody else to put money in it, you can't do milestone-based financing and your deals won't get funded. Doerr did this when he invested in Netscape and said the internet is going to be, as he famously said, the greatest legal creation of wealth in history. And he was probably right. After the internet bubble burst, we went to a couple of new sectors. One, y'all remember nanotechnology? That was, had a lot of promise, but was way too long in an incubation period, and it died. Then came cleantech, along with government subsidies. John Doerr has been the main spokesperson for this industry, and I just am noting what happened in the last couple of weeks. He started something called the S Fund, which is a social networking fund. They, of course, are big investors in Zynga, and he just led the investment in Twitter. In fact, I Googled a couple of days ago, John Doerr hot markets. And up until a couple of months ago, all you saw was cleantech. And now cleantech is like number 4 or 5. It's Zynga, it's Twitter, it's Mary Meeker, the internet analyst. So I think what we're going to see happen there is Kleiner Perkins is going to de-emphasize cleantech. For the main reasons, I think, is just they're realizing you need major government subsidies and the returns won't be as good as they are in internet. And as a result, a lot of capital from limited partners who've been putting money in that space are going to say, what should we do next? Well, I think he's pointing the way, and he's saying it's gaming, it's social networking.
He finds the bubbles, and everyone chases the bubbles.
He does,
right.
He does, and he speaks very positively about bubbles. He says bubbles are good. They are what attract massive amounts of capital into a sector to do something important. Lastly here, a couple of points I wanted to make.
By the way, did you see, I sent this thing around about Twitter math. And
Yeah.
if you look at revenues, because that's, I mean, it was 150 million that Doerr's put in totally, you know, Kleiner Perkins. Twitter right now is worth $3.5 to $4 billion. Facebook, with the new shares post at $25 a share, is worth, what's it, $56 billion. So if you apply this Twitter economics and Twitter math, because it's based upon revenues, to existing companies, like Apple would be worth $2.7 trillion.
Yeah.
Trillion. So this Twitter math, it kind of resembles 1999 again.
Yep. Yep.
Yeah, and it's a very good point. And as I said, there were 2 things that happened to me that were noteworthy in a material way to my industry in 2010. One was the fact that I think clean tech has maybe reached its peak in terms of venture participation. It will certainly continue to get a lot of investment from government. And the other is
American venture participation.
the other. Thank you, Alex. The other is valuations. And Ken, to your point there about Twitter's valuation, whatever it is, 40, 50 times revenues. Facebook at 57 billion. Keep in mind, and the markets always price securities at the expected value that's going to be created in a business. At this point, of course, if what the economics of Facebook were to remain where they are today, it would be worth 7 or 8 billion. The expectation is it's going to be worth a lot more. But keep in mind, for the most part, it's a business that bases its value on advertising. And over a long period of time investing in ad-supported business models, I have found those are hard over a long period to make good money on. The only one who's done it really, really well, really through lead generation, has been Google. Keep in mind that the top 10 companies, I've mentioned this point before, the top 10 internet companies in 1999 had 70% of all online advertising revenues. And I just saw a statistic a few months ago, the top 10 have 70% of all advertising revenues. A few of them switch places in the rank order, but they're all pretty much the same ones. Which means it's very hard to start a company and to get into that top 10 slot and make a lot of money in this area. And let's be clear with Facebook, though I'm a big fan, with this $57 billion valuation, I couldn't help but think, this sounds so much like Yahoo back in the late 90s, where internet-supported business, billion-plus page views, multi-billion page views a month. It seemed like a really compelling business model, and it lasted, let's say, still around, but for about 15 years. It was a very durable company. I think it's now starting to implode. Will Facebook last that long? Well, here's one test. I think you have to always use some sort of mechanism to think through a bubble. And my partners and I do all this time. We do relative valuation comparisons, like you just said, Ken. Hey, what would Apple have to be worth if we applied the same metrics as Twitter? You know, the size of the U.S. economy. Okay, maybe there's something weird going on there. You all remember the first bubble I lived through, which was the Japanese bubble. Tulip, no, that would be no.
I still think they're coming back.
Sorry about that, Nolan. Was the Japanese real estate bubble in the late 90s. And in the city of Tokyo, I still remember this.
Late 80s.
I'm sorry, in the late 80s, I apologize.
He's always on.
How old does that make you now?
Who said that?
Stand up,
In the late 80s, the city of Tokyo, if you took the price per square foot of its real estate, and there were a lot of transactions, was worth more than all of the real estate in the United States.
No, that's not true. It was worth more than all the companies traded in the New York Stock Exchange. That was the actual figure.
No, it was real estate. I'm just talking about real estate. So it was, the Tokyo real estate was worth as much as all of the real estate in the United States. So if you...
Including Bel Air?
You're right. So whenever you have these weird sort of comparisons, you know there's trouble going on. So we have Facebook doing what it's doing, you know, 57 billion market valuation, sounds great, but I'd ask you this, if you could give somebody today $1 million worth of Facebook stock, or $1 million worth of Disney stock, but you had to keep it for 20 years, what would you want? Yeah, you say Disney. I think so too. I think Disney has weathered the test of time. They have multiple business models.
How about 10 years?
10 years? I would still say Disney. 5 years? I'd probably go with Facebook. But that's a very dangerous game to play, right? Because what we're all really saying is, oh, I would really like to own Facebook and get out before everybody figures out what it's really worth.
Let me ask one quick question because I know you're wrapping up. Can we just talk about you said Yahoo's imploding. I mean, it's kind of sad in my eyes because I'm not sure here, when we saw Yahoo come up and it became this company and this portal and it was like it. And now we see Carol Bartz just dissecting it and selling, Delicious is going to go away and I don't know what Yahoo is. I feel kind of sad seeing where Yahoo is going to go next year. I'm not sure if it has life. And to me, it's kind of like an era dying if it does go away. Where do you see Yahoo?
Well, what I think about Yahoo is, it is, as I mentioned, an ad-supported business. Those businesses require traffic. And for the market to value them highly, they have to assume that tomorrow is going to be better than today. And that's not the case for Yahoo. It's, as a homepage, it used to have a very high percentage of people who made it their homepage. That's going away. And it clearly in the international markets, with the exception of some of its assets overseas, if those were peeled away, we've done this analysis at a previous metal, Yahoo's base operations in the US would be worth nothing. So I think Yahoo ultimately, obviously the great blunder of the last 5 years in any M&A was to not take Microsoft's offer. Right? I think the shareholders have a real gripe with the management for doing that. And
that was ego.
That was purely ego.
Yeah.
It would have been better to have had a deep-pocketed company like Microsoft. Frankly, I think the lifestyle of the Yahoo employees would have been way better. Microsoft pays a lot. They have a monopoly through Windows. They get 25, 30 billion of free cash flow every year. Yahoo would be much different and probably more competitive. But don't give up. I think Microsoft still might go out and ultimately buy it.
$20 a share.
Right, right. It's going to be I wouldn't even think $20. So last thing I will say here, though, before we go into the gaming business is this. One troubling sign I see in the venture industry is the amount of money that's chasing these so-called hot deals, which in my mind don't offer a lot of fundamental technology or fundamental value. They are pieces of a lot of existing technologies bundled together.
They're features.
Features which have brand value and have ad-supported models, great, but what about the sort of the mythology of venture capital? And that mythology, and it's maybe half myth, half reality, but right now it looks a lot more like myth, around funding the next big technological development. What I see us doing, and I see all the returns coming from, are businesses that are more unlikely to have enduring long-term value and unlikely to really change the American competitive landscape. What I'm talking about is how many VCs are investing in robotics, are investing in bionics, are investing in space exploration, even things like medicine, fertility, life extension. Those are really tough nuts to crack, and as a result, and with uncertain payoffs. But there's always been a compact between venture capital and our government, and that has been a very good one. DARPA, the Defense Advanced Research Project, has given a lot of its technology funded by the US military to the startups, to venture capitalists, to help commercialize important technologies. I don't know if any VC even knows who the head of DARPA is right now. That's bothersome to me. The other is that we have so much hype being built around great valuations that I think we're going to all start to see, the public markets will see, ultimately the people will see that, wow, the venture capitalist returns are all coming from these sort of entertainment-oriented businesses. Great, but it's dangerous, because if you aren't investing in next waves of fundamental technology, then at some point you become less competitive. And so that's just a word of caution, something that I'm bothered by. And I think if the clean tech, while that may or may not be a great investment, I like the idea of the U.S. government working in partnership with venture capitalists to do something that was important and beneficial. We will have to see if we get the same level of support in terms of regulations. Things like visas, HB1 visas have been hard to come by, but much easier for venture capitalists and startups to get, because we've said, look what we're going to do with that. Tax, we just talked about this very important tax holiday. Those sorts of things, the people say, we'll give those to you if you provide something back to society. And if you don't, then why should you be treated any better than any other industry? And so that's a cautionary and worrisome thing about the last year. Every time, I'll finish with this, Ken, every time the mass media has become fixated on valuations or fixated on numbers, from how much is Amazon and eBay and Yahoo going up in value every day, Maria Bartiromo in the late 90s, Mark McGuire and Sammy Sosa in 1998 chasing the home run record. Every time they get preoccupied with a number, everybody gets uneasy, and I think it's because we start to realize something funny is going on. And it's either steroids or it's companies that don't deserve valuations and a lot of plummeting values. So that's kind of the cautionary note I would leave with at the end of 2010. Thanks, guys.
By the way, I would highly recommend you listen to Wlliam's conference